On January 28, 2026, the Bank of Canada made a decision that affects every Canadian with a mortgage and everyone trying to buy a home. So they held their policy rate at 2.25%. No cuts, no hikes, just a hold. And the key part is the governor said that the timing and direction of the next rate move is uncertain. They're not sure if the rates will go up, will go down, or stay exactly where they are today. That uncertainty actually matters because millions of Canadians are making mortgage decisions right now based on what they think will happen next. My name is Jenny. I'm a mortgage agent working all across Canada. If you want to talk through your specific mortgage situation, the link to book a meeting with me in the description. So today I'm going to break down what just happened this week, what it means for the mortgage rate, what's coming in 2026, and most importantly, what you should actually do right now. Let's start with what the Bank of Canada actually did. So, on Wednesday, the Bank of Canada held its policy rate at 2.25%. This is the rate that influences borrowing costs across entire economy, not just the mortgages. The bank rate remains at 2.5% and the deposit rate at 2.2%. This creates the operating band for overnight rate. But the number that matters the most is 2.25, which is the policy rate. Think of the policy rate like the temperature dial for the economy. When the bank raises it, borrowing gets more expensive. When they cut it, borrowing gets cheaper. When they hold it, cost stays relatively stable. This rate does not directly set your mortgage rate, but it influences everything. It affects the prime rate, which affects the mortgages. It affects market expectations, which actually affects the fixed mortgage rate as well. And it signals how the Bank of Canada views the economy. Here's what they said this week. The governor warned there is unusual potential for new economic shocks. Global uncertainty, trade policy risks, and concerns about US Federal Reserves, all those are making them cautious. In plain language, the Bank of Canada is not confident enough to cut rates further, but they're also not ready to raise them up. Right now, just waiting. The Bank of Canada has been cutting rates since 2024, bringing the policy rate down from 5% to 2.25. That's a major easing cycle. But as of January 2026, that cycles appear to be paused, possibly finished, at least for now. The Bank of Canada policy rate is 2.25. This is the overnight target rate. Banks charge each other this rate for very short-term lending. They don't pay this rate directly, but it influences everything else. The prime rate is currently at 4.45%. This is the rate banks use to price loans for their best customers. Prime moves almost 1-for-1 with the Bank of Canada policy rate. Variable mortgages rates are priced as prime plus minus a spread. For example, if your mortgage is prime minus 0.5% and the prime is 4.45%, your rate is 3.95%. Variable rates move when prime moves. Prime moves when the Bank of Canada moves. Okay, so fixed mortgage rates work a little bit different. They don't follow the policy rate directly. Instead, they follow bond yield, especially the 5-year Government of Canada bond. When lender gives you a 5-year fixed mortgage, they are looking at their own funding cost in the bond market. That is why fixed rates can move even when the Bank of Canada does nothing. As of late of January 2026, 5-year fixed rates right now roughly in between 3.6 to 4.04 range, depending on the lender, on your profile. 5-year variable rates are approximately at 3.5% to 4%, depending on your discount of prime. If you are waiting for mortgage rates to return to 2.5%, that's unlikely anytime soon. Those were emergency pandemic rate, not our normal condition. Today, fixed rates in the high of 3s to 4s are much closer to the long-term historical norms. So what happens next? The Bank of Canada has 7 meetings left in 2026. So we have the March 18, April 19, June 10, July 15, September 2nd, October 28, December 9. Most economists expect the Bank of Canada to hold at 2.25 for most, if not all, 2026. Some see small changes of maybe hikes later in the year, possibly to 2.5, 2.75, if inflation will actually peak and growth will improve. Very few expect additional cuts unless something breaks. That means stability for now, but also the risk of surprise might happen. So what should you do? If your values certainty fixed makes sense right now, locking in a rate around 3.7, 3.6% give you that predictability. It protects you if the rates rise later in 2026. Fixed also makes sense if your budget is tight. If you're comfortable with some risk, variable can maybe save you some money. If rates stay flat or fall, variable will outperform fixed like it did previously, but there is more upside risk than downside right now. So if rates rise, your payment rise. My general guidance is this. If you are a first-time home buyer or your budget is stretched, fixed usually makes sense. If you have strong cash flow and you have your flexibility, variable can work, but make sure you can handle a payment increase if a few $100s a month. Always compare both and always shop around. Here's what you should do based on where you are right now. If you have a variable mortgage, nothing really will change for you until the next Bank of Canada announcement. But watch the upcoming Bank of Canada meeting. Make sure your budget can handle increase. And remember, most variable mortgages allow you to convert to fixed without penalty. If you're renewing soon, start early, compare lenders. Don't assume your current lender will give you the best deal because most probably they will not. If you are buying a home, get pre-approved now. Lock-in rate hold. If you are watching and waiting, pay attention to inflation and employment data. These are the signals that will drive future rate decisions. Even Bank of Canada is telling us they are uncertain. Make decisions based on what you can live with, not what you hope will actually happen.